Hey everyone, thanks for joining today's video. In this video, I'm going to do my weekly review of my $212,000 Wealthsimple stock portfolio. We're going to talk about some of the stocks that I bought over the last week or two, some of the stocks that I've actually sold here, and then some changes I've made to my watch list on top of just looking at how the broader markets performed in the last week. So we're just going to start off by going into how I did over the last week. While this loads, if you don't mind giving this video a big thumbs up, it really does help with the YouTube channel, as well as consider subscribing if you like this kind of content and haven't already. So as you can recall probably from the last few weeks, the portfolio has not been doing well. Down $5,000 in my Canadian account here, over to my US account, down another $2,700 over the last month. Where in the last week it rebounded a bit. Well, not really. I got back to flat at least, which I'll take after what happened over the last month here. So in my US account, up about 400 US dollars. In my Canadian account over the last week, down about 600. So all in all, it was pretty much a wash in this last week. Comparing that to the broader markets here, the TSX was down about 0.7%, give or take. Going over to the US, you see the NASDAQ here run on a bit of a run, particularly on Friday there to finish the week up 1 to 1.5%. The Dow here is about flat on the week, once again behind that run on Friday as well, where they gained a pretty decent amount. And then I just wanted to look at the XRE, which is the Canadian REIT index, essentially. It's an ETF at about 15 bucks a share here. You can see year to date down over 10%. In the last week, about flat. And I like looking at this because I do own a bunch of REITs across my portfolio for income. And one of the reasons why my portfolio is down so much throughout the last month, as you saw a couple minutes ago, is really the REITs I've owned have just gotten crushed. So you can see here, not necessarily an outlier versus the total index here. At least I'm calling it an index, but it's essentially an ETF. And when looking at the whole year range, we're pretty close to the 52-week lows, which is interesting to see. So going into what stocks I was buying this week, I'm going to go through this pretty quick because it wasn't anything necessarily new in my portfolio. The first thing I was buying was Canadian National Railway. Over the last week, I think it actually held up pretty well, about flat. But in the last month or a couple months, we've seen a pretty notable dip, about 5% here in the last quarter on CN Rail. And CN Rail is one of those companies that personally I just like always having a pretty nice size position in it. And I like to always be adding to that position over year, no matter what the price is really. So whenever it goes on a dip, I kind of take it as my opportunity to buy my shares for the year as I look to grow this into a bigger and bigger position year over year. In addition to the shares, this company also buys back lots of their own shares, so you get increased ownership on both ends by acquiring more shares and by there being less shares outstanding. In this particular account, I have 90 shares of CN Rail. I'm just looking at CN Rail at a whole here, trading at about an 18 to 19 times current year PE and about an 18 times next year PE, I believe, which is one of the cheaper valuations I've seen on CN Rail over the last 5 or 6 years. With that being said, lots of companies are trading at lower price to earnings ratios because of where interest rates are. But for a company I'm planning to hold for 10, 20, 30 years, I take it as one of the stocks that could be a good opportunity for me to build up into a bigger position during this time of increased rates. Starting yield of 2.1% on this one, but they do a pretty good job of increasing the dividend year over year. So not going to get rich on this one overnight, but it's a safe stock in my opinion, given the moat they have, given the markets that they are in to invest in. So that's one that I built up about 4 or 5 shares in the last month here. Going into the second stock that I was buying this month, it was quick service restaurants, I always say, but that's just their ticker, QSR, Restaurant Brands International. So I actually bought a couple shares of this one on Friday on their dip. They went down about 2.5% on Friday, down 5% on the week here. I think they're expected to do about $5.30 of earnings per share next year. So at these rates, trading at about 17 times earnings for 2024, whereas lots of other restaurant stocks like Yum Brands, McDonald's, you name it, trade in the mid-20s. So I think they have great brands. They own brands like Popeyes, Burger King, Tim Hortons, acquired Firehouse Subs recently. And they have a long runway of global expansion on lots of these brands. So this is one that I think is too cheap relative to its peers in terms of price to earnings ratios. And I love the diversification of the brands they own, whereas a company like McDonald's, which I also own, primarily only really owns the one brand. They own brands across spaces, a chicken brand, a burger brand, a sub brand, etc. So that's great. They also trade on the Canadian Stock Exchange, also on the US Stock Exchange, but I own them on the Canadian Stock Exchange, so I don't have to deal with any FX fees or tax implications for owning stocks in other countries with this one, which is also a bit of a plus. But I just like buying this one on weakness. It's really ran up. I'm up still 15%, even though I'm averaging up on it, but up almost 20% in the last year here. You can kind of see was over $100, getting it at about a 15% dip from that top here. Okay, next stock I was buying Jameson Wellness. This is one I've talked about for a couple months now. Finally got up to about 100 shares here as I continue to average down. Still down about 4%, but not too concerned about that as it's still a pretty small position. If the stock stays at this 23, 24, 25 range, you can expect me to continue to be buying this one in future weeks, getting it up to a bit of a bigger position there. Into the US out of my portfolio, Coca-Cola just crashed in the last week here. So up on Friday, but over the last week was down 5%. By Thursday on the day, it got down to almost 7% versus last week. So I added to this one pretty aggressively over the last week, putting about another $1,000 in it, getting my cost basis under $60 for the first time, which was nice. Obviously, I have a long way to go versus the current stock price of $53 here. But overall, getting a starting dividend yield of 3.4% on a company that's increased their dividend for 60 plus years. Price to earnings ratio has dipped to the low 20s, which is still, rich. But Coca-Cola never really goes on a huge sale. And whenever they have, it's been a huge buying opportunity. So I think, the stagnation in the stock price over the last number of years is a good opportunity for me to build up a position for the long term in a globalized, well-rounded dividend king who's had a really good track record. So I've been buying more Coca-Cola shares. And then the last stock that I've kind of been buying a bit more of is S&P Global. So I'm up to 9 shares now. I think I was at 7 shares last week. So bought a couple more. These stocks are expensive. $365 for one right now. So it's about like 500 Canadian bucks per share in S&P. I think they also offer fractional shares for those who are interested. But you can kind of see here they're on a bit of a dip. I think they're expected to do just over $13 of earnings per share next year. So their price to earnings is like at that, let's call it 27 and a half range. They have tons of recurring income. They have huge moats in lots of the business units they operate in. They've done a really good job of exponentially growing their earnings profile over the last number of years. So similar to Coca-Cola, it's been this kind of flattening of the stock price over the last year and a half, even going back to before the pandemic. It was only about 15% lower at that point, and they've really fundamentally changed the company with an acquisition and whatnot. So I think this one is another one that I'm just investing in for the long term. I think they'll continue to grow their earnings per share. That price to earnings ratio that I bought into will continue to go down. They'll continue to increase their dividend, currently just sitting at 1%. And it's one that really I feel like diversifies my portfolio well, because I don't really have a stock like this. And it is a really unique business to own in terms of the index business they own, the ratings business they own. So I think it's a great one to mix into my portfolio. Going into a stock I sold this month. So I sold a bit of my cash account here as I raised money for some of these buys with the market going down. So now I used to have CASH, now I have HSAVE, which is Horizon's Cash Maximizer ETF. This one I was a bit confused about. It kind of goes up and down a bit more than I thought. You can see here, even on Friday, it was like down 33 basis points, which seemed like a lot for a cash position. Whereas I was used to this ETF here, which paid me a dividend at the end of each month, and it literally never really went down except for the day it paid the dividend. So maybe it's because they're holding 30-day, 60-day bonds or high interest exposure, and as interest rates went up over the last week or two, it impacted their value of some of their short-term bonds slightly. But I'm pretty sure this just sits in a cash account. So I was surprised to see any day where this really goes down more than like 0.01%. So if anyone knows more about, what the background of that, would love to hear from you in the comments. But nothing too bad happened over the whole week. It was still up about 0.3%, just fine. Just interesting to see some of the day-by-day variances up or down 10 cents here, 20 cents there. Surprised to see that. But anyway, sold about 10 to 15 shares of this account. It used to be at about 17,000, now down at 15,800 in my cash position here to fund some of the acquisitions we just talked about. The other stock that I sold this week was TKO Group. Always have a hard time saying that, which is the merger of UFC and WWE. It was nothing personal about the company. It was just at the time I sold it, I was actually at about $85. So I sold it at a good time throughout the week. And I was up about 2% on the position. It wasn't really a core holding. It was more of a trade or seeing if the stock was going to crash. I was going to average into it as the valuation got more attractive. And with lots of my other stocks trending downwards and more core positions that I was trying to build up, I didn't think it made sense for me to be holding this kind of more speculative or just more non-core holding at the time, because it wasn't really playing from a space of extra capital. It was playing from a space of capital at a time, or with capital at a time that I really needed that to be averaging down on some more of my core positions. So I believe I literally took the money I got from this one, directly bought a share of S&P Global, directly bought 3 or 4 shares of Coca-Cola, and that was it. So I just moved this one into those two holdings, which I'm more aggressively trying to build up. If this one keeps going down or goes down in 75, 70, and the rest of the market is going up, I'd relook at it. I still have it on my watch list, but it was one that I dropped from my portfolio, even though I only had about 6 shares or something like that in it. Okay, going into my watch list now. So my watch list, I added a few companies to it that I've actually looked at before, just going into my watch list on the right-hand side of the screen here. So, having some complexities. So one of the stocks that I added to my watch list was Airbnb. It's kind of been all over the place. So I just wanted to make sure I was keeping an eye on it, as lots of the rhetoric in the travel space has gotten negative over the last handful of weeks. You can see here the stock's down 7.5% on the week. If I turn that over into the month, down 13% in the last quarter, only down 4%. So they've kind of had a bit of a roller coaster, but still down over 13% in the last month for this company. When I look at their earnings per share estimate here, going to do about $3.60 this year and about $4 next year. So trading at about 32 times next year's earnings, closer to 35, 36 times this year's earnings. Still too expensive for me, in my opinion, at this level in the 120s. But you can see just how fast stocks like this with higher PEs don't pay a dividend. A bit more, I hate to call Airbnb speculative, but a bit more uncertain in terms of what's going to happen with the economy, how the travel space is going to be impacted. So these stocks can move pretty aggressively to the upside or the downside, depending on what's going on. So I just didn't want to miss like a big move to a price territory that I was more comfortable with. With Airbnb, currently sitting at a 32 times forward earnings. So I don't know what number essentially I'd be interested in, but if it got to a point that it was in the mid to high 20s, I think that would be a more reasonable spot to potentially start nibbling into an Airbnb position again, in my opinion, and how I value the company and their growth rate. But I'm not necessarily dying to invest back in Airbnb. They don't pay a dividend. Their share buybacks mostly just to offset share dilution from their employee stock plan. And who knows what's going to happen in the travel space over the next few years. Maybe there's a better entry point. I'm not necessarily really interested in doubling down on this space. I already own Disney shares in one of my accounts, but that is my only kind of travel exposure, for lack of a better term. Just wanted to add this one to my watch list as I've seen it kind of get hit over the last couple weeks. And another one from my watch list that I have added from the travel space is Wyndham. So Wyndham Hotels is one that I actually entered a position in a handful of months ago. Let's see if I can see it on the chart. As soon as I actually bought into the position, they skyrocketed. Where was it here? It's probably, okay, I guess it was, oh yeah, June. So it was around here. Bought in for about $67 a share. And then it was some merger news with Choice Properties, which is another, or Choice Hotel Chains, whatever. And the stock jumped like 10% in a handful of days. And on that, news, which I thought was very unlikely to take place, I ended up just selling the stock for the 10% gain. I thought even if the deal did go through, it would be very unlikely for it to be a cash deal. So it was kind of just like a manufactured value increase, and then you get shares in the joint company, and you're pretty much buying the shares yourself for 75 or 80 bucks a share, whatever the price was. Anyways, so I dumped it. It's kind of gotten back down, and it hit 66 bucks again. Looks like it trended up a bit near the end of the week, potentially. But this was one that I really like their business model. I just don't really love the valuation they're trading at. I'd say it's similar to Airbnb in terms of how I feel about the company. But I love how they primarily just have licensed their brands to franchisees. So they just collect royalty revenue every single month. They're pretty much a royalty company. They take all of that money back each year, about $500 to $600 million in royalty revenue. And pretty much all of it flows down to the bottom line. They pay a dividend with about 30% of it. They buy back some of their shares. You can see here they have about a 2% dividend, so decent starting dividend yield. And then they invest for growth with the remainder. They open new brands and new demographics, new spaces. They expand globally. They do all these other things in terms of investment in digital and their loyalty program, just to fuel that flywheel of guests continuing. And every single time a guest continues, they open a new hotel, or one of their partners open a new hotel. That opens up a new profit center for them to continue to get more and more royalty income, buy back more shares, increase the dividend more, invest in more global expansion. And overall, given they are a pretty asset-light business model, they only have about a $5.7 billion market cap here. And when you look at all the businesses they own or all the brands they own on this page, you'd think that this would be a bigger company. Now, the one thing that I do kind of caution everyone on when looking at Wyndham is they really paint this picture of being a business that really is for all consumers in the hotel space. They have upper mid-scale, they have upscale, they have luxury, they have upper upscale, economy, mid-scale. But this is primarily an economy business, despite it only being one of the 7 pillars here. The brands like Days Inn, Super 8, Howard Johnson, Travel Lodge, these banners, let's call them, for lack of a better term, still make up about 30% of all of their revenue here. So I thought it was more, to be honest, from last time I looked at it. So it seems like maybe they're diversifying a bit more, but it's still a very big part of the business that you have to be aware of. And these are pretty much lower end kind of stays, less profitable for the franchisees on a per person basis. If someone's staying in a room for 90 bucks a night or whatever, Wyndham's only getting like $1 a night or $2 a night, versus if they're staying in the Wyndham or the Wyndham Grand, that number is like $300, $350 a night potentially, depending on what time of year. So they're continuing to try to diversify up, buying more brands. They recently bought Vienna House in Europe, and some of these other acquisitions that they've made in recent years. but that's just something to keep in mind. They do still have a really big economy business, about a third of the business. And like we said, the pipeline's really important because every time they open a new room and open a new hotel, which kind of go hand in hand, they're opening more profit centers around the world. It's the same thing as McDonald's opening up more and more McDonald's around the world, getting more and more sales through their channel and through their network that they are getting a percentage of. And then you can kind of just see here their development pipeline is really skewing international, about 60% international, 40% in the US. The one thing to note, though, is they tend to have better economics in the US because they don't have master franchisees. In lots of international markets, they have a middleman kind of operating the business there that they split the royalty fee with. So you'll see if you look through their investor presentation, I won't go through all of it right now, but while they have almost half of their restaurants, I believe, outside of the US, it's like not close to half of the revenue because they're splitting lots of the revenue from those, I call them restaurants, but I meant hotels, with other parties. In terms of what their key priorities are for this year, always driving net room growth is super important for this business. I think essentially how it works is on an annual basis. Once again, if you want to see this more visually, it's in the presentation, but they hold on to about 95% of their hotels. So about 4 or 5% of their hotels or their franchisees leave the network every year. That may be to go to a competing hotel, that chain like Marriott, whatever, if they feel like they can invest and meet the criteria for those hotels. That may be them just going independent, not wanting to pay the franchise fees and everything else that goes along with being a part of the network. Maybe not feeling like they're getting value out of the scale, out of the loyalty program, whatever. So they tend to start the year down like 3 or 4% on hotel rooms. And then they try to grow 6-7% on gross growth in order to achieve that 2 to 4% room growth throughout the year. And the way they grow rooms is, one, development, which you saw in the last slide. They can just build up hotels themselves, sell those hotels to investors who will then operate them, and they sign them into 20-year leases or partnerships with one of the Wyndham brands. Or maybe they will develop a hotel in partnership with someone, already knowing that that will be a Wyndham brand hotel, and maybe they give them a break on the royalty fees for the first number of years in order to get them in the door, something like that. The other way is transferring current hotels. Maybe these hotels are individually run. I think those are the ones they primarily go off of, selling them the benefits of being part of the broader network, the benefits of the loyalty program that they've kind of built up in the space, the benefits of having the brand recognition of one of Wyndham's brands. And the other spot that may be a bit harder to pull people from is competitors and competing brands. So brands like Choice Properties or the Marriotts or the Hiltons and all of their more discount brands, and saying, hey, you're paying them 7% a year in royalties. I'm making up a situation. If you come over here, we'll give you a break for the first 2 years, and selling them on reasons why the Wyndham brands in that price range are better than the Marriott or the Hiltons, or their loyalty program's better, or whatever it may be. So those are kind of the two drivers to pull growth from. Obviously, the sell story is easier for someone that's not already with a franchisee. But I think they do both in order to offset that 3 to 4% decline on organic room impact from people not renewing their agreements to get to that 2 to 4% growth. So it's a bit of an uphill battle, but they seem to be doing it pretty successfully over the last number of years. And then just looking at their earnings per share, going to do about $4 this year, $4.30 next year. So on $4, they're trading about 17 times current year earnings. It's a bit rich for me for a conventional, traditional hotel business. I do like the fact that they're asset light. I do like the fact that they're really good at returning capital to shareholders, whether that's dividends or share buybacks. But I'd really like this one closer to a 15, 14 times. So it's not one that I'm dying to get into here, especially with some of the discounts we've seen in other areas of the market and interest rates where they are. But it's definitely an interesting game, and that's why I put it back on my watch list. I made reference to the share buybacks, but look how great this company's been at buying back shares. In 2019, so this is about 4.5 years ago, the company had about 100 million shares, 97 to be exact. and now they're down to 84. So they pretty much bought back, 15% of the company, give or take, in a 4-year span, which is really great return of capital to shareholders. So that's just showing how the benefits of having an asset-light business model and not really having opportunities to invest that money in a ton of things across the business, because you don't own the capex schedule for most things, other than construction, other than marketing, stuff like that. So they have no other place to do with it, to put it smartly, other than investing back in share buybacks to increase shareholder value of their individual shares. So I really like how they're very committed to that part of their capital allocation strategy. So those are a couple of the stocks that I added to my watch list, just showing you kind of the last couple stocks in my watch list. I did add TKO Group back on because I dropped it from my portfolio. Some of the other stocks I have here, Vici Properties is one I have on, but to be honest, I've been buying more realty income when I want exposure to like US REITs. Just feel like I like the monthly dividend, first of all, but also there's broader diversification than Vici. But I do think Vici is a great company, still has some unique elements to it that I think will help it continue to grow long term. VFV is just a Canadian S&P 500 proxy ETF. Diageo is another one I was watching, and then Brookfield Infrastructure, both the same stocks here, just in different types of corporations, has gotten hit super hard with interest rates going up. So wanted to keep an eye on that, because they do have some great assets when you overlook the debt situation they're in as well. So that's kind of my overall watch list here. I hope you guys liked me going through these stock buys, these stock sells, some of the stocks I'm watching this week. If you like this kind of content, be sure to give this video a big thumbs up, especially if you made it all the way to the end of the video. I really do appreciate your time and appreciate you making it to the end. If you haven't yet, be sure to subscribe to the channel, and I will see you guys in the next one. Thanks.